So what happens is you see that fewer people can get approved. Therefore, you have fewer people in the market. Therefore, you have a little bit less demand, and that could impact prices.
Hey everyone, Kevin Amos, Pine Financial Group, where we work together so you succeed. Hey, you found us here on Facebook or on YouTube. Be sure to hit like or subscribe and leave some comments below. Joe or me would love to interact with you. Got a special guest. You guys have seen him on the channel before, Joe Massey. He's a friend. He's one of our preferred lenders. And Joe and I today want to talk about the credit markets and what's going on with the tightening credit. So Joe, if you could, maybe 30 seconds, 1 minute, something like that. Tell us who you are, and then we'll dive into the topic.
Yeah, my name's Joe Massey, Castle & Cook Mortgage. Have been a business colleague, partner with Kevin and Pine Financial for, going on 10 years now that we've been working on transactions together. It's been a great ride. And, what I do is permanent residential financing. So, your 30-year fixed rate mortgage for your house, your property in the mountains, your investment property, your 15-year loans, things like that. Any sort of residential mortgage, 4 units and under. We finance a lot of condos, a lot of multi-units here around Denver, and just want to be a resource for Kevin, for Travis, Justin, for everybody on the channel, for questions that you might have about long-term financing.
Fantastic. I've been reading a lot of economic news, as we all have, with the COVID-19 and everything that's going on. And there's a lot of fear out there, Joe, and people are thinking that there's going to be this giant housing bubble burst and the values are going to crash, and people are sitting on the sideline a little bit, real estate investors specifically, thinking that they're going to get these fantastic deals. I don't agree with that, and I've talked about that before on both on the channel and in our newsletter, and we can get into that if you'd like a little bit, but there is a couple of things that I'm watching, inflation being one, and tightening credit being the second. The two things that could potentially have an impact on real estate. So I wanted to bring you on the channel. Concern might be tightening credit. So can you tell us a little bit about what tightening credit is and what impact that can have on housing?
Yeah, absolutely. So tightening credit, a real simple way to describe it is, let's say that you've got, a lot of banks out there and they're competing, jockeying for, clients to come in and do loans with them. And they all go down, for an example, to a 600 credit score. And then something changes in the market and they all say, man, you know what? These guys that have a 600 credit score seem to be a little bit risky. And looking at my portfolio that I've got of these loans I've done, seems like those are the ones that are struggling to make their payments. So I think we're going to move our minimum credit score from a 600 to a 620. All right. And now maybe I've got another bank that looks at it and says the same thing. Hey, I'm going to move my credit score from a 620 to a 640. And then maybe you've got another bank that says, I've looked at it, I'm going to move my credit score from a 600 to a 660. And then you get kind of this herd mentality that everybody starts moving their credit scores up. And that would be tightening credit. That if I'm a home buyer and I have a 601 credit score, all of a sudden I can call all these different banks and I can't get pre-approved because I no longer meet the minimum requirements for all these various companies. So that's a simple way to look at it, but it could be many things. It could be tightening credit. It could be requiring more down payment. It could be requiring higher savings in the bank. It could be lending on only certain type of properties. It could be requiring more income. There's lots of various ways that could be tightened, but that's a simple explanation.
So tightening credit, in the simplest definition, would be harder to get a loan.
Yeah, harder to get a loan. You have to be better qualified, better income, better credit, better assets. Yeah, so more difficult for some people.
Yeah, good. So what impact is that going to have on housing, or what could that do to housing?
Yeah, so that was a hypothetical. Let's talk about kind of what's really been happening. So myself and many other companies, we used to have a minimum credit score of 580 that we could go down to for an FHA transaction. For us, that's actually moved up to a 620. Some lenders have moved that to a 640, 660. There's even one large national lender that they've moved their minimum credit up to a 700 credit score. So let's say that you were pre-approved with that lender, and now you get under contract, you call them up, say, okay, I want to get my new loan. And they say, oh, you know what? You're not pre-approved anymore because our guidelines have changed. Now, nothing has changed with the actual buyer. The only thing that's changed is who's giving them the loan. So what happens is you see that fewer people can get approved. Therefore, you have fewer people in the market. Therefore, you have a little bit less demand, and that could impact prices, theoretically. And a lot of people are saying, oh, but that's why values are going to go down. That's why this is going to happen. Well, Here in Denver, we have about 1.2 months of inventory. All right. If you took the buyer demand and you cut it completely in half, that means that months of inventory would double. You'd still be only 2.8 months of inventory. You'd still be in a very strong seller's market. So tightening credit is going to impact people probably at the lower credit bands, lower down payment, less positive qualification factors, but it's not going to be enough of an impact to drive prices down, to show a big halt in demand in the market.
I love how you mentioned months of inventory because that basically that statistic is supply and demand, and supply and demand are what drives values. So what we're talking about when we mention tightening credit is a change in demand maybe, but that leaves out supply completely.
Right. Supply is still historically low, right? Prior to COVID-19, you go back and you look at March 1st when COVID-19 was just barely hitting the headlines. Guess what? We have massive shortage in housing in Denver and in the nationwide real estate market. That hasn't changed in the past 60 days, right? It's not like suddenly we built all these homes that are going to house people. So whether people are out of work, whether people are still looking for homes or not, we still have a massive shortage of the number of people that need a home, want a home, can afford a home compared to the number of homes that are available. So I've heard a lot of people compare this to 2008. Oh, the banks were doing away with stated income loans. They were doing away with this loan. And you had to have a bigger down payment. All those things are true. We are seeing some tightening in the credit market, but it's not enough to say all of a sudden this demand is just going to halt and then supply is going to far outstrip demand. Supply is still so low. I don't see that there's going to be a decline in prices.
Yeah, and it's interesting. Now I'm thinking out loud here, but if there's a extreme tightening in credit like we saw in 2008 and 2009, builders have a hard time getting loans too.
That's
and
right.
That means that they're not going to be building as much, which further keeps inventory low.
Yep.
So that would be another argument that maybe there is some stability in housing right now, even in a tightening credit market.
Yeah, I think you're exactly right. I still think there's a lot of opportunities to hold properties. There's a lot of opportunities to keep your rentals, a lot of opportunities to keep your rentals filled. There certainly might be some short-term impacts with, folks being laid off or missing a month or two of rent here and there. But I still think it's a great long-term opportunity to hold your rentals. You might see a handful of distressed sellers, somebody that's been furloughed, that's been laid off. But I don't think you're going to see massive foreclosures. I don't think you're going to see, 20% foreclosures like not everyone, but some people are predicting.
Right. So some of the headlines that I've read recently, Joe, I want to get your opinion on these. And then I want to just ask you what you are seeing in your business, what some of the guidelines are so people are aware what they can still qualify for.
Yeah.
But Redfin put out an article, I think that was last week, maybe a week before that. But they said 25% of the loans that funded in Q1 of 2020 would not fund today. That's a pretty big number for their lending group. You mentioned Chase without saying the name. Chase came out saying that they're changing their guidelines to 700 and a minimum down payment of 20%. We talked a little bit about FHA. I have heard that some lenders are going all the way to a 660 credit score to qualify for FHA. And FHA buyers, frankly, are a lot of the buyers for our clients buying their fix and flips.
That's right.
And then some of the other large banks, Chase, Wells, and some of the others have said that they're no longer issuing lines of credit.
Yep.
So tell me a little bit about what you're hearing, some of the bigger guys doing, and then what guidelines, you've mentioned one, but what guidelines are you seeing in your business?
Yeah, good question. So what I'm hearing, a lot of lenders are doing exactly what you said. They're tightening in various different aspects. And the way it's impacting our business has actually been really, really positive because we did move our minimum credit score for FHA from 580 to 620. Other than that, we've not made one change.
Wow.
So some lenders have stopped doing cash out loans. Again, I won't name names, but you can make a few phone calls to some of the large national lenders. They have really high minimum down payment requirement, really high credit score requirement, no longer issuing home equity lines of credit, and have stopped doing cash out loans altogether. So for us, we have not changed on that. You have an investment property, you need to take cash out of it. Fantastic. We can help. You have an investment property, you need to take advantage of a super low rate that's available right now. Fantastic. We can help. If you're a 581 FICO score looking to buy your first home with FHA, unfortunately, we cannot help. So, there's been some of the folks that are at the lower realms that have been knocked out of qualifying for right now, but the vast majority of the market, we're still able to help, although not every lender is able to help. And I think that comes back to what you said. FHA buyers, those first-time home buyers, are the ones buying the fix and flip properties that a lot of your clients are selling. I think now more than ever, it's important to vet the buyer and the buyer's agent, that they're solid, they're sound, they have their down payment, they know what they're doing. But you really have to vet the buyer's lender. You want to make sure that they're on sound financial footing, they can get you to the closing, have a disaster recovery plan and have enacted it, that they are prepared to fund this particular transaction for your buyer. And if they have had changes, are these changes going to impact your buyer? Because you've got a pre-approval letter that's 45 days old. Maybe nothing has changed with that buyer. The buyer's still working, everything's great, but maybe that lender has had massive changes, because there have been lenders that have gone out of business. There have been lenders that have laid off upwards of 80% of their staff. There's been lenders that have said, you know what, we're actually not even doing originations right now. So you really, if you're selling a property, want to vet that buyer and that buyer's lender, I think is more critical now than ever.
Okay, and before we close, I just want to talk about or mention jumbo loans. That's really been in the news a lot, almost non-existent. That has not been my experience. We have clients doing $2 million spec homes and they're still selling, just like, seems like normal. But I have been reading about jumbos and the lack of liquidity. What are your thoughts on that?
Yeah, so jumbos are they're their own breed, right? And what I can tell you, if you call me, and I guess I should say this hasn't been a big impact on my business because it's not something we do, but this goes back to your last question. I no longer do jumbo loans because we don't have an outlet where we can sell them. Now that skipped over my mind because it's not a big focus of my business, so it hasn't really impacted us. But if one of your guys wanted to call me and do a $2 million loan, I would have to politely say I can't help. But that's not really that critical, because most folks that are getting a jumbo loan for $2 million, $3 million, $4 million, they probably have a private banking relationship with a Chase, a Wells, a Bank of America. And those folks are still offering those jumbo loans. So that has not made a big impact in that market. But if you call a guy like me, who's an independent mortgage banker, and say, hey, Joe, I want to get a jumbo mortgage, I'm not going to be able to help you with that. So where that could impact would be somebody that wants to buy $1 million home and doesn't have 25% down. They've only got 10 or 15% down. Those programs have really gone away. So really what you're looking at for those larger homes are folks that are really, really well qualified and folks that have a great down payment and probably already have some sort of banking relationship with a large national jumbo lender. Most of those people already do. About the only folks that are really getting squeezed out of the jumbo market would be your lower qualified folks, not necessarily FHA quality folks, but folks that maybe haven't had a stable job, haven't saved up as much down payment. And previously we could have done like a jumbo 10% down. Now they need 25%. They're not going to be able to qualify. So I don't see that it's going to really make a huge impact on the jumbo market. If you might see 5-10% of people that are not able to buy. So you might see just a little bit of an uptick of the months of inventory, but it's not going to bring it to a screeching halt by any means.
Okay. I didn't realize that you weren't doing those anymore. So that's interesting and good to know.
Yeah.
So I guess in summary,
I think it's temporary. We have a great relationship with our jumbo lenders, and none of our jumbo lenders have gone out of business. They've just said, hey, you know what? Right now, the market is too volatile. We got to put on the brakes. We're not going to buy any jumbo loans for right now. We'll get back to you guys in 30, 60, 90 days. And hey, we've said, no problem. We've got outlets for all of our core pieces of business. We totally get it.
Okay, good. So I guess in summary here, if we're going to see some impact in housing, it's probably going to be on the jumbo side, which most real estate investors are not working in that arena anyway. Could be in the low end with the FHA stuff getting a little bit tighter.
Yep.
But in general, inventory, at least in the markets that we work and that you work, Joe, inventory is too low to see a big impact in housing.
Yeah, I agree 100%. And just one piece of advice I'd give to anybody out there getting a loan, you might be asked for a few additional things than you were a year ago or 2 years ago or 3 years ago, particularly if you're self-employed. You know what? Your loan officer, your lender, they're doing the very best they can. any information you can provide them is just going to help them. They're not trying to make it more difficult for you. They're trying to get your loan approved. And we've got a lot of rules, a lot of guidelines, and frankly, some uncertainty that can change from one day to the next. Just like some of the stay-at-home orders, stay safe at home orders, those things change rapidly. Lending guidelines can change rapidly as well. So if they ask you for something, you say, man, I didn't have to get this the last time. Probably true, but I bet the last time you got a loan wasn't right in the middle of COVID-19.
Right.
So do the best you can. And I can assure you your lender, your loan officer is doing the best they can too.
All right. Fantastic. How do we reach you?
You can reach me via email, jmassey@castlecookmortgage.com. My website, loansbyjoemassey.com. Or, of course, you can just call me on the phone, 303-809-7769. Thanks so much for having me on, Kevin. I really appreciate it.
You're welcome. And I assume if we get some comments, some questions for you specifically, we let you know and you'll be able to respond to those.
Yeah. If you want to tag me, I'll certainly watch out for those. I watch your guys' channel religiously every time you put out a new video. But if I do happen to miss a post, make sure you just tag my name and I'll be happy to comment on it.
All right. Fantastic. And if you're looking for hard money, check us out, pinefinancialgroup.com.